Let's finance our first television series in our modules. Our amazing movie franchise Kill Me Now is now going to be made as a television series. We are going to have Netflix on board, who bought our US rights for 7 years and will pay us 35% of the budget. We are shooting this series in Canada, where many television series are being shot, and our budget there is estimated to be $25 million for 10 episodes in this first season. We are going to structure our finance plan using Canadian incentives through a co-production. Obviously, we're using our distribution sales, meaning pre-sales. We're using a bank loan, and we're using equity and more stuff. So let's start with our Canadian co-production incentive. We're going to get 30%, but only on the below the line expenses of our budget. And the below the line expenses are defined as $18 million. So we're not getting 30% on the entire $25 million. We're only getting 30% on below the line, which is all the production and crew, which is $18 million. And the Canadian producer who is helping us with the incentive is going to get a producer fee of 5% as well as 50% of our back-end profit participation as producers. Our sales reflect 70% of the budget because we excluded Canada from our foreign sales. And Netflix, as we mentioned, acquires the series for 35% for US and Canada. Netflix is paying 10% down, and the balance is paid when we are delivering the series to Netflix. So we're going to have to cash flow this contract with our bank. Our pre-sales in Europe reflect 30% of our budget. And again, 10% down payment is applicable here, and the balance is paid by the distributors on the day we deliver the series. So in both cases, for the US and Canada, where Netflix buys the rights, US, Canada, for 35% of the budget, we're going to get a 10% down payment from Netflix, and 90% will be paid on delivery of the series. And for pre-sales, altogether reflecting 30% of our budgets, the foreign distributors in Europe will give us also 10% down payment from our distribution agreements and then pay the balance, which is 90%, when we deliver the series to them. The sales agency fee is 15%, and we're going to deal with 1% distribution expenses, and it's paid on all the sales we have made. And the sales fee is also deferred after we have paid our bank loan back. So there is no fee due before we have paid our senior loan. The senior loan, meaning our bank loan, will cash flow our pre-sales and will apply a discount. And we're going to get 80% of the pre-sale amount cash flowed by the bank. So that is 80% of the Netflix deal and 80% of our European deals. The bank will charge us an interest of 9%. And a loan fee of $50,000. And the gap loan is going to be 20% of our budget, meaning a maximum of 20% of our budget, but 50% of the collateral we have available. The equity is going to finance the balance under industry standard terms. We have a few more financial components to our finance plan. We have brand integration and crowdfunding. So we're going to get brand integration from a brand that supports our series with $350,000 with their products and branding in our series. And we have to pay 25% as a commission to the ad agency. Crowdfunding has also been given to us of $250,000 when we are going out and doing a crowdfunding campaign, and then we pay a commission on that of 15%. All the funding is released on closing, so there's not anything available to us before then. The in-kind services we are applying for the series would come from post-production. The post-production is actually deferring 50% of the post-production costs. And the post-production costs reflect 15% of our budget. So that means 15% of $25 million is post-production, and of that, 50% are being deferred. The premium that we're paying when we are recouping this deferment to the post-production house is 10% of the amount that is being deferred. We have some good residuals applicable for WGA, DGA, and SAG, and that is $50,000 paid out of the collection account. The back-end profit participation that we need to deal with are, we are giving some back-end points to the director, showrunner, and the cast. They each receive 15%. And as mentioned before, our Canadian producer receives 50% of whatever we are left with. Let's take a look at our funding schedule. First, we have determined that our budget was 25 million, but we are reducing it by the deferred amount with the post-production house. Remember, that was 15% of the budget. Of that post-production amount, 50% is being deferred. So our strike price would then reduce the budget to 23,125,000. That's important to know because that is the amount we actually have to finance. We don't have to finance the entire 25 million, but only the strike price, which is 23,125,000, because a portion of our post-production budget was deferred and is not payable until we make money in the recoupment schedule. Again, here we have our US and Canada Netflix deal, 35% of the budget. That comes to 8,750,000, and that is 35% of the entire budget, meaning 25 million. We have our international sales estimates excluding Canada. 70% of 25 is 17,500,000. So our gross distribution revenues that are expected to come in is 26,250,000. Let's figure out what our down payment is. We have Netflix with 35%, as mentioned earlier, 8,750,000, and then we made some pre-sales as well to some European distributors, and they all together come to 30% of the budget, and that is 30% of 25 million, and that is 7,500,000. So our pre-sales altogether would therefore be 16,250,000, and the distributors will give us 10% as a down payment. So we get at closing of these deals, when we are negotiating them, 10% of 16,250,000, which is 1,625,000. So that's our first money that we have now available to finance a portion of our production cost. So now we're going to do our senior loan, and here's what that looks like. Of all the pre-sales we have made to Netflix and to Europe, the bank will give us 80% of that value, which is 80% of the entire pre-sale amount, which was 16,250,000. So we're going to have a cash flow loan from the bank of 13 million. The down payment is going to be deducted here because we already received that money. So the bank will reduce their loan by 1,625,000 and give us a pre-sale loan of 11,375,000. They're going to charge an interest of 9% on that, which is 9% of 11,375,000, which is 1,023,750. So the net cash flow loan that we have available now, with deducting this interest, is going to be 10,351,250, and that is simply 11,375,000 minus the interest of 1,023,750. Now let's look at the gap loan. As you know, we're going to get to the unsold rights by taking all the sales estimates that we have established with our project and deduct all the pre-sales. So we are left with $10 million in unsold rights values. The bank will look at that and say, I will only give you 50% of your unsold rights value, and I will only pay you up to 20% of the budget. So in this case, in our case here, the unsold rights value is $10 million. And the 50% collateral value would then be $5 million. And the budget is also 20% of 25 million is also $5 million. So it happens to be the same in this case. So we would get a gross gap loan amount of $5 million. And here too, we have to pay the interest of 9%. 9% of 5 million is 450,000. The bank will also charge us a loan fee of 50,000. So we're deducting that as well. So we're deducting 450,000 and we're deducting 50,000. So altogether we're deducting 500,000. So of our gap loan gross amount of 5 million, we're left with 4,500,000. So altogether, the money that we have available from this loan to cover a portion of our production budget is 14,851,250. What we have to pay back, though, is the gross senior loan amount, which includes all these fees, all these interests and the loan fee. And that is $16,375,000. So here's what our finance plan kind of looks like now. We had our bank loan of 14,851,250. That was the net bank loan. We had the down payment that we received early on from the distributors of 1,625,000. And now we're going to talk about the production incentive, crowdfunding, brand integration, and in-kind services. So remember that our production incentive was 30% of the below the line portion. So that is 30% of $18 million, which is $5,400,000. The fee that we were paying to the co-producer was 5%, so we have to deduct 5% of $5,400,000, which is $270,000. So we're left with $5,130,000 for the production incentive. Crowdfunding, we were able to raise $250,000. We're paying an admin fee of 15% of that, which is $37,500, and we're left with $212,500 for crowdfunding. Brand integration, we did a sponsorship deal for $350,000. The brand agrees to pay everything up front, and the advertising agency charges us a commission of 20% of that, or 25%, excuse me. 25% of $350,000 is $87,500. So we're left with $262,500 from brand integration. Our post-production cost was 50% of 15% of our below the line. So that is $3,750,000. Sorry, not of the below the line, of the budget, I apologize. So 15 million of 25 million is 3,750,000. Of that, 50% were deferred, which is 1,875,000. So that is the 1,875,000 that we are deducting from our budget of 25 million, which gets us to the strike price. So altogether, we have now financed 22,081,250. So we're leaving equity to be made available to us and to come to 4.18% of our budget. So that is 1,043,750. So this amount is made available to us to meet our strike price. Strike price is not the budget. So to cover the cost, the actual cost of this production, this first season, we would need equity to come in with 1,043,750 in order to finance the strike price budget. So we produce a series, everything is done, we have finished it, we are delivering it, and now we can start looking at our recoupment schedule and looking at our revenues. We have US and international distribution revenues that we had established at $26,250,000, meaning the Netflix deal and all the international sales estimates are now coming in. And we did already receive in the beginning $1,625,000 as down payment from these distributors, so we need to deduct that here. That means we're left with $24,625,000 from worldwide distribution revenues gross. As always in our recoupment schedules, we are now going to pay all the parties we are connected with in our series. First in line is our collection agent. 1% of the amount received in the collection agency account is due to the collection agent, which is $246,250. We're going to pay our senior loan back next in our ranking position. The senior loan, including all the interest and all the fees, is $16,375,000. The sales agent charges us 15% of a sales fee connected with the international distribution rights, ending up being $2,625,000, and distribution expenses are also connected to the international sales, which is what the international sales agent is doing for us. Here we're paying him $175,000. Total due to the sales agent in regards to sales agency fee and expenses in connection with the international distribution of a television show is $2,800,000. SAG residuals are $50,000. The equity investor is going to get his investment paid back, $1,043,750, as well as the premium of 20% due in connection with the equity investment, $208,750. So altogether, the equity investor receives $1,252,500. Last,
we are paying our post-production partner the deferment, which is $1,875,000, and also the premium that is due on this deferment, which was 10%, $187,500. So altogether, the post-production house now receives $2,062,500, and our total expenses come to $22,786,250. At this point now, we are sharing our back-end profit participations, which is driven by our net revenues. The net revenues are generated by taking all our expenses and deducting them from our distribution revenues. So we are left with $1,833,750 in revenues. The equity investor receives 2.9% of that. The director and showrunner and cast each receive 15% of that. So our total due to these parties is $865,821.41. The balance of $972,928.59 is now shared with the co-producer, who receives $486,464.30, and the same do we as the producer.